Federal Reserve Bank of New York President John Williams says U.S. monetary policy is in a good place, but officials will need to parse through data to decide on how to proceed on interest rates. He spoke in an exclusive conversation with Bloomberg economics editor Michael McKee at the Bloomberg Market Forum in New York.
What makes a good sneaker?
Well, I think it depends on your mood. It depends on your day ahead of you. What are you doing that day and how you're feeling. And some days I feel like more colorful, flamboyant sneakers, and some days you feel like the more traditional dress sneakers. So it's part of dress for your day. That's part of a policy we have at the New York Fed. You decide what fits with the work you're doing that day, and that's how I view it.
Taylor Heineke, who was a quarterback for the Washington Redskins last year, now with the Falcons, apparently he bought a new pair of Jordans every time they won. Mm-hmm. Do you go out and buy a new pair of sneakers every time you raise rates?
No, I do not. I don't think my wife would approve, given the space we have in our closet. No, I don't do that, and I let them. I wear them a lot, so I wait till they wear out and look for what's next.
All right, we've got our poll results in now. 35% think that you should raise rates, but 45% think it's time to hold. This is the everything, everywhere, all at once question about the Fed. So let me pose it to you now. We'll start off right off the top. September 20th, which of those choices would you favor?
Well, first of all, it's not the FOMC meeting yet. We still get more data between now and then. And we, as I always tell my economics team at the bank, we get a lot more of the analysis and research and, kind of the forecast coming together. So there's a lot more information and thinking that before this meeting, of course, before, future meetings. But here's how I see things now. Obviously always focused on our dual mandate, maximum employment and price stability. Inflation is far too high. But that said, inflation is moving in the right direction. We're seeing the imbalances in the labor market, which were really quite pronounced last year. They've been closing. Job openings have been coming down. The quit rates coming down. The hiring rate in the markets coming down. So we're seeing movement in the right direction of bringing supply and demand back into balance. Seeing inflation come back towards our 2% long run goal, and we've done a lot. I think everyone knows, here in this room, we've raised rates significantly over the last year and a half or so, and we've gotten into a restrictive stance. So my answer to the question is right now, I think we've gotten monetary policy in a very good place in terms of we have a restrictive stance of policy. It is having the desired effects of bringing demand and supply more into balance. We're seeing inflation move in the right direction, but we'll have to watch going forward. We'll have to keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again to make sure that we're keeping that steady progress in terms of getting imbalances, shrink imbalances in the labor market and bring inflation back down. So right now I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do.
How do you know you're restrictive? What metric do you use?
Let's see, how long did it take to get to R-star? Okay, so I think there's no right answer to that question. I think, the way I think about it is really in terms of real interest rates. That's the Fed funds rate, or more broadly, Treasury yields relative to expected inflation. So, depending how you measure it, you look at it, real rates are, well above zero, moving, somewhere between 1% and 2, and that seems to be above typical estimates of the long-run neutral real interest rate. And I think the other way you see it is a little bit of in what we're seeing in the economy, right? So we are seeing demand in the labor market come down according to a lot of different measures. We are seeing other kind of signs that the economy is moving, imbalances in the economy are coming down. So I think the two things, one is kind of like where's R versus R star? That's one way to think of it. But the other is what are we seeing happening in the economy? Now there's a second test. There's kind of are we restrictive? And the second is is, are we sufficiently restrictive to really make sure that we're bringing inflation sustainably down to 2% and getting the job done? So, I think it's pretty clear we're restrictive. It's still an open question as we go forward. Have we got sufficiently restrictive to achieve that?
We'll get to R-star when we get to, Tom called it the eco-babble part of our conversation here. But first, you have raised rates 11 times. You've gone up to 5.5% top range, but unemployment remains extraordinarily low, and we are seeing signs of the economy accelerating now. So do you really think you're sufficiently restrictive?
Well, I think, first of all, the unemployment rate has been relatively steady over the last year or so. It's fluctuated between 3.4 and 3.8% where it is today. And I think that it's a sign that, well, clearly we're not moving, significantly to more imbalance and unemployment even lower. And nor have we seen clear signs of unemployment moving, significantly up. But I do think it's a unique time, right? Because if you look at the unemployment rate, it seemed to kind of get to a minimum value of around 3.4%, kind of get there. But then these other indicators have been shifting. So I think what we've seen in the labor market is demand exceeds supply. It's not showing up as much in the unemployment rate continuing to go down, but it's showing up in these other things like job vacancies, quit rates, things like that. So to me, the things I'm focused on is really how are we seeing the demand indicators, supply indicators move together. I would expect the unemployment rate to edge up over the next year somewhat. But again, I see positive signs in the sense that the indicators of demand and supply are moving in the right direction. The unemployment rate hasn't moved as much. In terms of demand reaccelerating, I think we have to be careful not to overreact to, kind of shorter term developments and kind of look at the bigger picture. But it's definitely one of the risks I see out there. GDP growth in the first half was around 2%. The latest readings on consumer spending have been strong. So that is one of those question marks when I said, are we sufficiently restrictive? Do we have policy where it needs to be to make sure that we bring inflation down to 2%, to make sure that we get the imbalances, wring out the imbalances, if you will? I mean, if demand stays very strong or stronger than expected, that would be one of the factors that goes into my thinking on that.
There is a group of people who think that there was a temporary bump this summer in the economy. So I have to ask, did you see a Taylor Swift effect in consumer spending?
Well, there's definitely a Taylor Swift effect on consumer spending because people have been spending on the concerts, on the hotels, and everything. It's been a huge phenomenon. But, demand has been strong, and it's been strong. A bit of that rotation we were talking about a year ago, we're seeing that happen from goods over to services. People are traveling more, they're going to restaurants, they're going to shows. That's healthy. So we are seeing very strong demand in those areas. I guess the question is, how much of that is driven by a lot of the fiscal stimulus we saw in the past, the excess savings that people have accumulated from that period? How much of that is people finally able to go out and travel, finally feeling comfortable going in kind of packed rooms and things? So is that going to, or is that something that perhaps will last longer? So it's an open question. I think there are reasons to think that consumer spending won't stay as strong as we've been seeing. Saving rate is obviously coming down. The excess savings that we saw accumulated seems to be spending down. And there's there are always the lagged effects of monetary policy. We've raised rates a lot. It is more expensive to borrow to buy a car or a house, and those effects, of course, I think will get kind of more stronger over time.
Can't have an economist without two hands. So the two-handed argument about what's happening now is that the economy may be accelerating. Third quarter may be very strong, but then that sets a very high starting point for the fourth quarter, and we could see contraction because you can't keep it up.
Well, again, I think you have to look through the medium term, and I do look at the labor market as well. I mean, we are seeing, I would say, slowing in the labor market, in the hiring rate, and I think that's probably given us perhaps a little bit, maybe a cleaner read of what's going on. But, have to watch the data, understand, why is the demand continued to be strong? Q3 does look to be strong so far, and again, it's just part of being data dependent. Now, I go back to, if you ask me, what am I most focused on? Most focused, for sure, is inflation. I mean, that, we talked a lot about what's GDP, what's the, labor market looking like, but, we got to get inflation down from currently PC inflation is about a little over 3%. Core inflation is above 4%. We really need to make sure that we get inflation sustainably down to 2%.
One of the questions about that is what happens with this supply-demand imbalance, particularly in the labor market. And a fundamental question that's been asked of economists and central bankers is, do wages lead inflation, or does inflation lead wages? And what would be a sustainable level of wage growth to bring inflation down to where you want it to be?
Yeah, I think there is an answer to the question, and kind of, you asked me 3 years from now, what do I think wage growth consistent with 2% inflation is? Well, then I have a kind of a traditional view on that. It's going to be 2% inflation plus whatever productivity growth is. So you're thinking of wage growth of, maybe 3.25%, 3.5%, or something like that, right? Right now, I think there's just still a lot of dynamics going on in wages and prices coming out of the pandemic. We saw huge increases in prices of goods. We saw huge dislocations in the economy. We saw wage growth accelerate dramatically, and now it's starting to slow. So, right now, I'm looking at wage growth not as like I need to see this number on the screen, but more that, seeing signs that the labor market is cooling somewhat, wage growth is slowing and moving towards something that's more sustainable. So that's how I think of it. It's kind of more the how do all the pieces of the puzzle fit together in terms of moving towards our ultimate goal. Right now, I think the wage growth has slowed, kind of as a sign that we're moving towards that.
Well, the other side of the question, Chairman Powell about a year ago warned that there would be pain in bringing down inflation to target, but unemployment is, as you mentioned, 3.8%. The employment cost index for the second quarter showed wage growth at 4.6% above inflation. You're not making the masochists happy. I mean, where is the pain?
Well, I think, again, one of the things that's harder to assess is my own view is one of the reasons we've had very strong wage growth, very strong inflation, was that demand over the last year or two has really exceeded supply. And some of that has shown up in high employment, high GDP. A lot of that's shown up in longer wait lines, waits to get things, or things not being able to buy things, companies that can't, meet the customer demand. So as we've seen demand come down towards supply, and as we've seen supply improve, which I think is an important dynamic right now, what we're seeing is, inventories kind of move back towards more normal levels. Supply chain bottlenecks recede. So a lot of those dynamics kind of reverse, which is a positive, both in terms of the economy's growth. It's also a positive in terms of costs and inflation. So from this question about, well, how high does unemployment need to get to bring down inflation? I think first and foremost, we have to think about how we got the high inflation. And I think a lot of that was related to supply chain bottlenecks, global shutdowns of economies reopening them, very strong fiscal and monetary stimulus to boost demand. Now, as we reverse all of those things, a lot of those things will also, we're seeing that reverse in terms of the inflation data. I guess the way I would summarize this isn't kind of the traditional inflation cycle where you think about like a sacrifice ratio. To bring inflation down 2% or a percentage point, you need so much unemployment. Now, in the end of the day, because so a lot of this is really about effects of the pandemic on supply and demand that are being unwound. And I think that shows up in kind of our models and our analysis. There is still the open question, and I don't have the answer to that. Will, over the next year or two, will we need to see, or will we see the unemployment rate rise significantly? My forecast would be yes, we're going to see the unemployment rise above, say, 4% to maybe somewhere in the low 4s, which is above my long-run view of what the kind of normal unemployment rate is. But that would be just part of that process of really making sure the wages and inflation come back to levels consistent with 2%.
So we should expect September 20th, you put out a new summary of economic projections that probably your GDP forecast will go up, but your unemployment forecast will go up as well?
Well, I don't know. I can't speak for my colleagues.
Oh, sure.
Yeah, and we'll see. But definitely, if you ask me where the surprises have been in the data since over the last several months, one is GDP growth, demand growth has stayed remarkably strong. All that talk about we're about to have a recession has vanished. And I think on the labor market, I guess my view is that the unemployment is again my view I think consistently has been that we're going to we are going to see some increase in the unemployment rate, but not to levels that we've seen in past recessions. But it's a kind of an open question. This is such an unusual set of circumstances with the pandemic, Russia's war in Ukraine, all the things that have happened, all the things that are unwinding in terms of those factors. You can't say with any certainty exactly how this is playing out. I gave you a couple things that give me a little bit of more confidence that this forecast of inflation coming down over the next couple of years will happen. First of all, inflation expectations have been, with households and economists, but I'll talk about households, have been incredibly well behaved. We've seen 1 year ahead inflation expectations move up a lot when inflation went up. That's not surprising. Very consistent with pre-pandemic behavior. But short-term inflation expectations have come down quite a bit. They're still a little bit above pre-pandemic levels, but getting closer, around 3.5% versus around 3% or so. And medium and longer-term inflation expectations are basically where they were before the pandemic. And the second, I got to sell New York Fed research here. One of them is a survey of consumer expectations. But the other is we have this measure of trying to figure out what the underlying rate of inflation is. And it's a complicated statistical model looking at the inflation data. But it tries to read through the data and see what's the underlying trend. Based on the July PCE data, the underlying trend there is 2.8%, 2.75%. That's way down from the 5.5% we saw last year. And if you look at what's happening with shelter inflation, and you realize that the shelter inflation is inherently backward-looking because it's looking at all the rents that were signed over the last couple of years. Underlying inflation looks more like about 2.5%. Now, I'm not saying that the job is done or we're at 2.5%, but it is showing us as some favorable kind of, if you will, tailwinds in bringing inflation down. Inflation expectations have come down, and measures of underlying inflation have really come down quite a bit as well. And we're seeing that each month with the data.
Speaking of services, one of the things that Jay Powell talks about a lot is core services ex housing. But there's been a lot of criticism of that as sort of a dog's breakfast of a lot of different things that aren't related. And apparently in the last month, we saw a rise in that indicator because these people got paid. Yep. Because we saw a lot of financial services compensation go up. Is that really useful, that index?
Well, this is why I mentioned this what we call the MCT, is because it takes all the components of PC inflation or personal consumption expenditures inflation, takes them all, analyzes them all, and weights them according to kind of their signal that they carry for inflation. So I think that's a good way to think about, because each piece kind of has its own story, if you will, and own behavior. I think the reason it is kind of useful to look at this, core services excluding housing, is that because the other components of inflation have really been moved by factors related to the pandemic. Goods prices rose dramatically, car prices, appliance prices. Now they're coming down. We don't want to take super high signal from the fact that car prices are coming down, because that's kind of what we were expecting to see. Energy prices have come down. Food inflation, thankfully, has come down. So we really want to kind of understand which parts of this is really reversals of pandemic things, supply chain issues, which of them may be a better reflection of the imbalance of supply and demand. So I think, the core services category is probably a good place to look. How are we doing on the supply-demand imbalances? But shelter, honestly, is part of that, too. It's a big part of the inflation index.
Something that combines kind of all these issues together of wages and unemployment and supply chain issues is the automobile industry. I want to ask you how worried you are about a United Auto Workers strike, because it could put 150,000 people out of work, plus then maybe suppliers. Nothing like when we had millions of auto workers, but still a large number of people out of work. But if they got what they wanted, they'd get a 46% raise, which doesn't sound really sustainable for the economy.
Well, I'm not going to comment on the negotiations in that industry. So to me, that's not something for me to comment on. But I do think from the broader perspective, I mean, hopefully, any kind of negotiation or issue like that is handled kind of on its own. So we're focused on the bigger picture. This is a ginormous, if I can use a technical term, economy. Obviously, and we're always looking at the bigger picture, and there are factors that happen that affect how the economy performs at any point in time that we have to take into account in understanding what's happening in the economy. But again, we're looking at the medium term. Monetary policy takes typically a year or two to have its full effect of the economy. So, I'm thinking about where are we going to be, next September, where are we going to be, and after that, and how are we setting up policy today and in the future to best achieve those goals. Again, I think we're moving in the right direction, but we still have quite a ways to go.
I have to ask you about another, besides the auto industry, interest rate sensitive sector, and that's housing. Existing home sales basically are frozen at this point. So many people refinanced or took out mortgages that are extremely low at this point, and the mortgage rate's like 8%, so nobody wants to sell. Have you crippled the housing market for maybe a generation until those people die and sell their homes?
No, I don't think that's true. I mean, we've seen this kind of dynamic in the past. I mean, this isn't the first time that interest rates have been very low and then have gone up, or, and these interest rates today on mortgage rates, or at least in our lifetimes, Mike, are not the highest we've ever seen. But I do think that there is part of that dynamic. But I would kind of take a step back. I mean, there's definitely that dynamic taking place, kind of people choosing not to sell their house because there's this, value of the existing fixed interest mortgage. But I would go back to the broader, I think, context of this is I think demand for housing is significantly stronger today than it was before the pandemic. I think that the work from home, the hybrid, the remote work, all of that has created more demand overall in our economy for housing, and that has to be met with supply, and that takes a long time to bring on. We know that housing construction, has not kept up with demand. So I think that part of the dynamic that we are seeing with the housing market, there's still a lot of demand out there. That's why rents are still high. That's why house prices are, and the market is kind of moving in that kind of still coming back now, even with the higher interest rates. So I guess my answer to your question is I think that the demand out there will actually kind of push the housing market along, given the kind of the changes we've seen. Now, clearly, interest rates are a factor in that, but I don't think that they're the only factor that are going to people's decision making.
Let's shift gears a little bit here and bring in the ecobabble, as Tom Keene said, and talk about R-star, because you obviously have done the most work of any economist I know on R-star. Before we go into a little more depth, have you got a short explanation of what R-star is for people?
By short, you mean 30 minutes or 45 minutes?
Probably anything less than an hour will work.
Okay. No, I mean, the idea of R-star is actually pretty simple. You just ask yourself the question that if the economy is kind of just going at cruise speed, growing at its potential rate, the economy is at full employment and inflation is at 2%. If everything's just moving along at that, what would the real interest rate be? And our estimates over time have changed because the factors that affect what's the equilibrium of savings and investment in the economy, those things can change for a variety of reasons. We heard one earlier about demographics. I think that is really important. There are others too. So it's basically kind of some kind of basically normal interest rate you would expect in normal times. Now, we're not in normal times right now, right? Inflation is very high. The economy is still going through a transition. So, so it's really a benchmark to think about where do you think real interest rates are likely to be headed towards, real, inflation-adjusted interest rates. So it's a nice benchmark to think of it that way. But of course, it doesn't tell you today what an interest rate should be or shouldn't be. It just it's kind of a benchmark.
So is it a practical application that you use on a regular basis, or is it a theoretical concept that's nice to talk about?
Well, I think it's both. I think it is useful to, when you think about, like, you go back to the Taylor rule, which is John Taylor's basic kind of insight that you can think of monetary policy as doing kind of two things. One is when leaning against the wind, when the economy is strong, interest rates tend to go up. When inflation is high, interest rates tend to go up, and vice versa. But then you go back to the Taylor rule, you got to say, but up relative to what? I mean, it's and down relative to what? And so it is a nice theoretical thing. Say, well, there's a neutral and normal position that you're in, kind of cruise control, and then there's the one that you're adjusting relative to that. Now, in terms of a practical point of view, I do, obviously, I do think it's useful. I think it's useful because it's a summary statistic. It's like the unemployment rate in a way. It's like other GDP or something. It summarizes a lot of information into one statistic. statistic, and the work we did on this, and there's a lot of other people who've done work on this is valuable, is just saying, okay, based on the data we're seeing, what we're seeing in inflation and interest rates and GDP growth, what seems to be kind of what that neutral rate or that neutral interest rate is, and you get different answers depending on how you do it. So I think it's a useful kind of thing to, as a summary statistic. It's not the only thing you look at. Obviously, it's part of the broad set of kind of indicators and things we look at. But again, I find it as a way to capture some of these longer run trends in the economy that are moving slowly over time, and we should just keep our mind on. And they're like productivity, they're demographics, or factors like that are not about the today and tomorrow, but more about what's the underlying backdrop that monetary policy is operating in.
Well, it kind of leads into my next question. It's been very hard, as you're pointing out, to forecast what's going on with the economy. A lot of quirks in the data these days following the pandemic. But when you look ahead and we have the pandemic distortions behind us, what kind of economy are we going to have? Are we going to have a new normal, a new normal, the old normal? What do you see ahead?
Well, you're right. It's hard to know. I wrote a lot about the new normal after the financial crisis, so I do feel like we're getting to the new normal. I go back to these supply side factors. I mean, some people say, the Fed is focused on demand, but we think a lot about the supply side of the economy in our work. So I do think about labor force, demographics. I think about productivity, and I think about the kind of fundamental drivers of the economy, rather than the short-term cycle. So I think in many ways, the new economy, I think, is going to be similar to the pre-pandemic economy. We've seen labor force participation, surprisingly in a good way, come back in many ways, back to where it was before. It's actually quite strong for that 25 to 54-year-old group. We've seen immigration and visa flow, people coming in to work on seasonal employment through visas, that come back. So we've seen a lot of things kind of get closer to where they were before. Productivity trends don't seem to have changed yet. Always hard to know if there is that, but the data don't seem to suggest that. My view of R-star hasn't fundamentally changed from what it was before. So I think there's a lot of macro at the 30,000-foot level things that seem to be similar, but underneath that, a lot of changes in relative demand, like I said, for housing, maybe for cars, maybe for other things. A lot happening underneath the hood. I think the big question for me is, how do new technologies change this equation? We talk a lot about AI and things like that. So those are open questions. But I think that so far a lot of these kind of factors I think fundamentally drive our economy over the long term. They look to be getting back to similar to the way they were before the pandemic.
Well, we could go back to where we were before the pandemic, or we could go back even farther. I talked to, at Jackson Hole, one of your colleagues, and we were talking about, well, what if John's wrong about R-star and R-star is actually higher? This person was pointing out that in the 1990s, we had a higher R-star, we had higher interest rates, we had higher inflation, but we also had a lot higher growth.
Yeah, well, absolutely. So, when Thomas Laubach and I first started working on this a little over 20 years ago, we were really actually interested in the high growth area. For those who remember, we had the dot-com boom, we had the internet, the productivity boom of the late 90s, early 2000s, which was real. I mean, that really drove real incomes, it drove GDP growth, it drove productivity. And according to the theory that we'd studied, like all of us had studied, it would suggest that if you're in a high growth economy, you're going to have higher neutral interest rates because demand for investment is high relative to savings. Everyone's trying to invest more for this high growth economy. That pushes R-star up. We actually found it did. Our highest estimates of R-star over the last 30, 40 years are in that period. And that's really what drove that research, is to understand, hey, we're this tech boom, isn't this changing kind of the backdrop for monetary policy? And I think it did. And that was where we focused. After the global financial crisis, we saw the reverse happen for different reasons. So yes, the answer is, if we got another, and I hope we do, another period of very high productivity growth, strong underlying growth, that would change this equation. Haven't seen it in the data yet, but clearly that would be something that we would be, that would move R-star up. On the other factors like demographics and other kind of things, I don't think we've seen those changes yet. But again, this is something that it's an open question. We'll just keep watching the data.
Now, I can't let you go from this audience without asking about the dollar. I know what you're going to say. It's not the Fed's responsibility, but the dollar's impact on the economy is. So how do you take it into account? How do you account for what's happening when the dollar goes up and the dollar goes down?
Yeah, so if you think about any of kind of our analysis we do at the Fed, clearly we understand that we're not, yes, we don't make the policy for the U.S. dollar. We're not targeting the dollar. Absolutely not. We're focused on maximum employment and price stability. But in thinking about setting interest rates or the path of policy, that clearly affects financial conditions, affects yields, affects the fixed income markets, affects equity markets, it affects foreign exchange markets. These are the basic transmission mechanisms of monetary policy. So we think about how our actions affect financial conditions and feedback to the U.S. economy and abroad. We also think about how other changes in the global economy that affect the dollar and other things then feed back to our economy. So it's part of, if you will, our models that we use that are inherently global and understand those interactions. It's part of the dynamics of our system. So we understand that and do our best to take that into account. Again, focused on our maximum employment and price stability goals.
In Jackson Hole, you have a lot in common with the other central bankers of the world. We saw the chairman walking along with the head of the ECB and the Bank of Japan, and everybody's focused on inflation. Three of you are looking to bring inflation down. The Japanese are looking to bring it up. But how much coordination and talk is there at a place like that, or even around the world during the year, in terms of, as you say, how your policies affect other people and how their policies affect you?
Yeah. So we go and have meetings of the governors of the central banks from around the world every 2 months and discuss what's happening in our economies, what we're seeing, how those are. We think of those as spillovers and spillbacks, how the effects of our economies and our actions are affecting the others. So I think it's not monetary policy coordination. We pretty much all of us have domestic goals, inflation, employment, financial stability, but we do share a lot of information on understanding what's going on in the global economy, where the risks are, understanding kind of how our policies are affecting other countries, how their policies are affecting us, and so it's not coordination so much, but it is a really good dialogue. And I think one of the big benefits of being transparent and open around our policy actions and being very clear, including the dot plot and all of our other communication, is it helps people around the world to have at least an understanding. What's the Fed thinking? How are they going about the policy? Similarly for other central banks. And hopefully that reduces some of the uncertainty or surprises or kind of unintended consequences. Around the world. One thing that's been absolutely a positive is over the last few years, we've seen dramatic policy actions by the Fed, ECB, emerging market countries, even much stronger actions. And yet the global financial system has operated well. We haven't seen the kind of big shocks or taper tantrum kind of things. So, as we've all taken the strong and appropriate actions to deal with the events, we've also seen, I think, this all working kind of as intended without, creating unintended or accidental kind of negative effects across borders.
Paper got the most attention at Jackson Hole was Barry Eichengreen's warning that debt is unsustainable in the U.S. and other countries. And part two, which seemed to really upset the audience, was that he said nothing is going to get done about it because there's no political will. How much of a threat is debt, do you think, from an economic standpoint? How much does the Fed worry about it?
Well, as long as I've been in my profession, which is close to 30 years now, we've had unsustainable fiscal policy. When you think about these just projections, if nothing changes, what will happen to the debt to GDP ratio or something like that? Now, I do think it's really incumbent on the elected officials to address that kind of issue. And I think over our lifetimes, it has happened in different ways through either tax or spending policies. So from my point of view, it's really the responsibility of Congress and administration to make sure that they're getting us on a sustainable path and fiscal policy. From my perspective as a monetary policymaker, it doesn't. We're not constrained in any way by that. We're able to carry out our policy actions as we need to do to achieve our goals. But again, it is something that you think about when you realize that if something doesn't happen over next so many years, the fiscal situation in a way gets worse, not better. And we've seen that in the past. So we saw that with Social Security, Medicare, back in the 80s. We're seeing that again with some of those issues, and they do need to be addressed. But again, those are decisions by elected officials.
One last question. Revolves around comments from two of our guests on Bloomberg Television. One said, when he was asked what he would like to hear from you, he said, the Fed only speaks in platitudes. And another was, the Fed doesn't know what it wants to do, so what can they tell us? So I would like to ask you, with this audience here, for one last thought on what you would tell them now that you're not giving as much explicit guidance as you used to.
Well, I think we are telling people really powerful things. I think one is, we're absolutely committed to achieving the 2% inflation on a sustained basis. So there's not a debate about, are we trying to get to 2% or 3% or 1%? We're getting to get to 2%, and we're going to take the actions to do that and do the very best we can given our dual mandate. So that's a pretty powerful message. When I started the Fed back in the early 90s, we didn't have an inflation target. We weren't able to say to people, what are we trying to do and how we're going to go about it. Today, we're able to say, this is what good looks like. This is what we're working towards. Here's our view of where the economy is going. You get to look forward to another economic projections in September. That's our, collective view of, growth, inflation, interest rates. That's a snapshot, if you will, of 19 people of how we're thinking about that. So I think we are providing an honest, view of what we're trying to get to, how we think it's going to evolve, and what we're going to do. And importantly, as the situation changes and developments are different than we expect, we're going to adapt and change and in a way to is appropriate. I think the past year and a half has proven that point. I mean, we've moved quickly, we've moved appropriately, and we've adjusted as the facts have changed, and always with the same focus and unanimous focus on we need to achieve our price stability goal. Price stability is absolutely foundational to financial stability, macroeconomic stability, prosperity. So we need to get that. And now the questions that everyone's asking is, well, what exactly does it mean? What exactly is the peak funds rate? How long do you keep rates high? Well, that's going to depend on the data. But what we're doing and why we're doing it, I think that's crystal clear.
That's John Williams, president of the Federal Reserve Bank of New York, speaking with Bloomberg economics editor Michael McKee. I'm Charlie Pellet, and this is Bloomberg.